Hi, and welcome to Random Roger's Big Picture for the week of September 16th. Just one thing on the agenda, a little bit of current events, how to react to current events, and what that means, if anything, for any changes within a portfolio. You may have heard that early on Friday, the Bank of England bailed out a subprime lender in the UK called North Rock. The same type of subprime mortgage problem that's besetting everywhere. What? What was that? Oh, turns out North Rock was not a subprime lender. Whoops. No, seriously, I knew that. A little bit of humor. It was a function of being able to access liquidity. There'd be some reasonable debate as to whether or not the Bank of England should or should not have bailed out Northern Rock. Not for me to say concretely, allowing something to fail is a part of capitalism, but whatever. It was, accessing short-term liquidity. It wasn't subprime, and that's kind of an important thing. We're starting to move away from subprime, and now we're worrying about other things. And so this latest thing is one more bank that, it was down like 31% or something like that on Friday. Not really an earth-moving event. The British market was down 2% at one point during the day on Friday. It then closed down only about 1%. It did hurt some European banks. One that I own in particular, which has kind of been in the middle of a few things, Barclays, BCS in the New York, was down $1.75 to $48.15 on Friday. They're in this for a couple things. There's a lot of things going on right now with Barclays. They've got involvement with SIVs. They've bailed out 3 of them, or I should say injected liquidity into 3 of them. The stock is down a lot from where it's been. But in trying to assess what's going on, and certainly I could be wrong about this, but I think if you remember last week or the week before, I put up that chart, that long-term chart of Johnson & Johnson, Philip Morris, and Bank of America, and on there you saw some periods where there was ghastly outperformance. Well, at this point, we're not quite to ghastly. In fact, I don't think we're anywhere close to ghastly outperformance. It's down a little bit more than most of the other financials. The thing here is, okay, if there is going to be a failure somewhere out there, a big failure, this Northern Rock would not be a huge failure. If there is going to be something that fails, is it going to be a particular stock that you own? My hunch is, and if you look at the balance sheet, you might draw the same conclusion with Barclays, that if someone huge does fail, it's not going to be Barclays. So from that standpoint, then it becomes, okay, what do you do? Where I'm holding on to the idea. I still absolutely believe that it is still a great company, and longer term, kind of like Johnson & Johnson, which had some ghastly periods in the last decade, that this will work through. I'm not sure where the bottom is. I'm not sure where the top is on Barclays, so I'm not in a hurry to sell it. Now, this has had an interesting effect on the portfolio. From the peak, I imagine it's down close to 20%. And so obviously, it's had a drag on the portfolio, but at the same time, there are other things that are doing fantastically well, so it balances out. And so as the portfolio has moved up a little bit, it's recovered a fair bit from the decline. I think it's bounced back a little better than the market. But assuming that's correct, from the bottom, Barclays is now worth less in the portfolio, and the portfolio itself is worth more. So it's now become a smaller percentage. And this is kind of difficult to follow. This is kind of real arcane top-down stuff. But the position has itself been reduced without my doing any trades. So from here, it's kind of usually when I buy it new, I buy it at 3%. Now it's in the neighborhood of about 2%, give or take. From here, if something really bad happens going forward, the impact from here, so remember, we're looking forward, which is more important than looking back. The impact from here, if I just sit on my hands and do nothing, the impact from here is much less. That's kind of an important thing. We talk about overweighting and over and underweighting, tweaking, just shaving positions slightly or cutting back a little bit. This sounds kind of funny, and in a way, it's a fairly obvious thing. But this is just the wrong part of the market. We've been saying that, for months and months here. But now, the underweight to the sector, and the sector is underperformed, it's now even more underweight relative to the rest of the portfolio. So in that scenario, I don't really feel the need to make any changes based on where we are now and what we know. If the stock somehow does cut in half, which I think is just too much, but if it does cut in half as an island and the rest of the market isn't, certainly by then I'll take action. I probably beforehand, quite candidly. But I'm not sure exactly what that looks like yet at this point because there are plenty of other European financials that are down similar amounts. It's just Barclays is one that I own, and it's in the news a lot. Well, that was really about it. Short and sweet. Big Red Sox-Yankees series this weekend. Lots of football. Have a good weekend.